Good evening. Welcome to the earnings review, your tidbits into company financials and operational insights. Thank you for joining us as we broadcast from our Hampton studios in Harare, in Zimbabwe. I'm Ibn Mabunda, yo money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also chat with the most competent analysts on the market to ensure you're furnished with relevant and comprehensive analysis on the market. Tonight, we focus on Mash Holdings, a listed properties concern on the Zimbabwe Stock Exchange. Now, some quick facts on Mash Holdings. The entity is one of the top 5 property companies in Zimbabwe and boasts of over 37 properties under its belt. Having been established in 1966, the firm went on to list on the ZSE in 1969. Mash Holdings is invested in retail, industrial, commercial, as well as residential properties. Of note is the fact that its property portfolio is skewed toward industrial as well as office parks in a 43-46% distribution between the two. Also of note is the fact that the entity has several flagship buildings under its belt, including the majestic ZB Life Towers in the very heart of Harare, as well as the ZB Center, which has 11,000 square meters of office as well as retail space. Mash Holdings is also invested in property development, having spearheaded the development of Rua, a settlement 25 kilometers east of Harare. On to some quick facts where Mash Holdings is concerned. With a share price of 68 cents, the entity has a market capitalization of 1.27 billion United States dollars. And according to their most recent financials dated the 30th of September 2019, the entity had total assets to the tune of over 500 million Zimbabwean dollars. Its share price has since soared 700% since the beginning of the year, over which the real estate index mounted by over 700% as well. Of note is the fact that the all-share index of the ZSE has mounted 300% over the period. Now, its major shareholders would be ZB Financial Holdings with a shareholding of over 31%, as well as the Africa Enterprise Network, which has a shareholding of 18%. Now, some fascinating projects that have been lined up by Mash Holdings include a Belgravia office park, a 3-story building, which is expected to create value for the entity and also house the headquarters of Mashonaland Holdings. The firm is also looking at a 24-stand project in Rua, particularly in Windsor Park. Plus, in Westgate, they are also invested in a cluster house development. Now, with a promising tourism industry in Zimbabwe, the firm is also looking to invest into the tourism sector. And on the table is a deal worth over 15 million United States dollars with the Chinese firm Touchwood International for the construction of a 5-star hotel in the very heart of Harare. This, of course, will entail the revamping of the Charterhouse building into that accommodation facility. This facility will have over 70 rooms, high-end technology features, plus a helipad. In Victoria Falls, the entity is also looking to construct a water park in partnership with a Dubai-invested firm. Now, this concludes the segment of the quick facts. In just a moment, we will be crossing over to an earlier conversation that we had with the Chief Executive, Mr. Gibson Mapfidza. Don't go anywhere. Good day, Gibson, and thank you for joining us on the earnings review. Just as an icebreaker, how are you faring under the COVID conditions?
Good afternoon, Eben, and thank you very much and Equit Access for reaching out. I think we are going through some unprecedented times, and you tend to live for each day that you encounter, and there's a lot of feeling of uncertainty going forward, but we have to keep on going.
Fair enough. You recently issued a trading update for the first quarter. Would you want to shed light or just to give us a brief preview into some of those details that you spelled out in your trading update?
Thank you very much. So in summary, the property market continues to be riddled with several macroeconomic challenges. We highlighted some of those in our update, the normal forex issues, electricity, and also just the GDP going down and not supporting our tenants in terms of them generating sales and ability to pay rentals. When you look closer at our numbers, so this is as at 31 March, so it's year on year 2019 against 2020. Our revenue went up 44%. So these numbers I'm sharing, just to be clear, they are adjusted for inflation. So they are not the nominal numbers. So our revenue in real terms went up year on year by 44% to 30 million, up from 20 million as at 2019 March. And our operating profit went up in real terms as well by 8% to 18.9 million, call it 19 million, as at 31 March 2020 from the previous year. Then, yes, the COVID pandemic essentially is having a very negative impact on production and also GDP. So it has a direct impact on our tenants' businesses and also their ability to generate sales, which in turn will also help them to pay their rentals. But we are still to see these impacts in full going forward. The numbers we have shared are not including the impacts of the COVID-19. As you are aware, the lockdown started on the 30th of March. We had already gone through our first 6 months.
Fair enough. Can we talk about your occupancy, which jumped 3% over the first quarter? What steered that?
So in terms of our occupancy, what we have been doing at March is to try and ensure that the product that we sell is aligned to the requirements of our customers, being our tenants. So instead of deferring some of the critical maintenance works, we have been ensuring that we carry out the key works to ensure that our building functionality, the services, your lifts, elevators, the air conditioning system, and the general ambience of the business is also up to speed, and ensuring that our buildings are future fit. In addition to the maintenance works and also the general functionality of our buildings, our team has really been working hard in terms of focusing on our customers. And thankfully, that has seen some of our current tenants increasing their space uptake with us. So I would attribute that increase to the two factors, future fit of buildings and also our customer focus.
Okay. Also, in your trading update, you did indicate that the collection levels were down 70% in the first quarter. What would be your projections going forward, and what mitigation levels, measures are you taking to safeguard yourselves against the harsh economic times ahead?
Okay, thank you, Eben. So just to make it clear, the 70% that we shared in our update, it was just for the specific month of April. The ZSC specifically wanted to sort of infer, or for us to communicate to our shareholders, the impact of the lockdown and also the COVID-19 on our business. So the 70% was a total collections for the month of April. And I would say after the lockdown from the 30th of March, most of our tenants, so when we look at our tenants, those who we can classify under the essential banner in terms of your healthy and food, it's around 20%. So when you look at our portfolio, I would say 80% of the tenants, especially retail, were affected in terms of losing beneficial occupation. They couldn't trade, they couldn't make sales. And that partly explain why we collected during the month of May 70% out of the 100. Our normal average collection rate for the good month or pre-COVID was around 95%. But I'm happy to say, as of to date, we have our collections for April. Some of the tenants who were owing have since paid, and I think the number is now around 90% in terms of collections. Then going forward, in terms of measures put in place, what we have actually done is to try and enhance the health and safety of our buildings and encourage some tenants who can operate within the buildings to do so. What we have done is we have supplied the typical PPE, protection, sanitizers, and in some instances, masks. All our multi-tenanted buildings as well, we have supplied with thermometers to screen for temperature. So that will also help going forward in terms of ensuring that tenants will continue to trade in the difficult time.
In terms of your rental collections, there is a statutory instrument in place at the moment that gives a moratorium to tenants to skip rental payments during this COVID-19 induced lockdowns. What are your anticipations or expectations in terms of the knock that would have on your revenue collection?
Okay, thank you for that. I will actually take this opportunity to try and interpret the statutory instrument that you are referring to, which is SI 96 of 2020. So the first point to make is that SI is limited or it's applicable to the residential tenants, those who are using premises for the purposes of shelter. And in that regard, we think that intervention by government was overdue, especially when you look at the residential subsector, the bottom of the pyramid, which is your high density areas. We understand landlords in those areas were sort of forcing tenants to pay rentals during the lockdown and also threatening eviction. So our view is to say the intervention by government is trying to enforce collaboration during this very difficult time. So what it has done, it has created a protected tenant in the residential sector. And a protected tenant is one who doesn't pay their rental by the due date during the period of lockdown. And they don't have to prove that they don't have capacity, or they do have the capacity. Just by not paying their rentals, they are deemed protected. And they are then required, so the rental areas are deferred, and they are required to pay up those areas within a 3-month period, depending, of course, with the length of the lockdown. So I think that is the sort of the summary of that SI. It's limited to the residential, and also it's deferring the rentals. So when you then look at our portfolio in terms of our exposure in that residential, I think our exposure is around 8%. But when you then look at the location of our residential properties, which also talks to the sort of quality of tenants, we are at the top of the pyramid in terms of the residential hierarchy. And most of our tenants leasing those residential premises are corporate or are also the upmarket tenants in a way. So we have also monitored their reaction during the month of May. We are very happy that they continued to pay these rentals, notwithstanding SI 96 of 2020, which doesn't really give a rent holiday or remission, but it defers the rent going forward. But I think what is really essential is for the two parties, in terms of the landlord and the tenants, to come together, collaborate, and ensure that whatever happens is it leads to a win-win scenario between the landlord and the tenant. And what we have been doing as well as a property manager, property owning company, is to be very close to our tenants. They have conversations, understand their business models, and also how they're affected by this pandemic, so that we understand their scenarios, and we also support them where we think we need to support them.
Still on the COVID subject, have you had to lay off some of your employees during this period?
We have not laid off any of our employees. What basically we are doing is we are trying to ensure that whatever we do is informed by our business model. we think we are going through a very difficult time, and as a team, we want to come together and see what is sustainable for the current levels of the business. And you never know the eventual depth of this pandemic going forward, but we really hope that we don't have to go to that extent of laying off some of our staff members. What we have done in terms of managing our building running costs, maybe just to infer to that, is after the lockdown announcement, we sat down as a team. We looked at all our buildings, especially the CBD or multi-tenanted buildings, and we said to ourselves, how best can we help our tenants to reduce building running costs? So we had to sort of cut down the level of services during the lockdown. And I think it's logical to say, you look at your security, maybe during the normal days, you have 10 security officers. During lockdown, do you need 10? Maybe you need 5. Cleaning as well. And we also engage with the lift companies and the aircon company. So that is what we have done in terms of trying to manage our building running costs. And we will keep looking at our revenues and our business model. What is it that we can do during the lockdown, etc. But we really hope that we don't get to an extent of laying off team members.
Fair enough. Now the Presidium has announced an $18 billion stimulus package to cushion the economic effects of the pandemic. And part of that amount is earmarked for the business community. Are there any indications at this point that Mash Holdings could stand to benefit from such a scheme?
So at an industry level, what we have done is we have compiled the total impacts, business impacts of the COVID-19 pandemic through the industry, and I understand that it will be taken to a relevant ministry. So indeed, we have been affected in terms of our revenues, and at some point we need to sort of trigger our business model. So yes, we would hope that just like any other company, we have been affected. We have already compiled a paper at industry level. So yes, we keep hoping that the 18 billion will be spread to an extent. We also benefit from the facility.
Okay, I guess you just have to keep your fingers crossed where that is concerned. Now, in your trading update, you alluded to intentions of commencing the Westgate cluster houses construction in the third quarter of the year. And of course, there would be concerns to do with the ability to source foreign currency, because I think you highlighted the need to pre-order some of the materials that are required for such an undertaking. What are the plans in place to ensure that that very target is actually fulfilled?
Okay, so yes, we completed the servicing bit of that project in November last year. We're just waiting for the compliance certificate from City of Harare. It's just a matter of processes. And our intention was to start the construction of the actual houses in April this year, after all the designs were done by the architect and also approved. And we now focus to start the works, like you say, in Q3 of 2020. Measures we have put in place, the first one, obviously, we have pre-purchased some of the materials like bricks. We have pre-purchased 80% of the total required bricks, and they are already on site. We are also looking at pre-purchasing the aggregates. And in terms of Forex requirements, I'm happy to say when you look at a typical project like housing, the initial civil engineering works like your roads, your sewer, and your water, you tend to need a bit more of Forex, which we have already done. And so what we are looking at doing now is to construct the houses. And I think during that, before we do the finishes, like just doing the shells, most of the materials are locally available. This is your bricks, your cement, and your aggregates as well. We, of course, we're trying to create some buffer in terms of Forex for us to be able at some point in future to procure the finishes in bulk, maybe from out of the country. So yes, we have started building on that. Fortunately, we still have a couple of tenants who pay us in Forex. and that accumulation in future will be very handy in terms of buying the finishes for the houses. But in the next, say, 6 months when you start the project, we don't see a bigger risk of Forex. The idea is to do the shell. And at some point, we think when things have stabilized and we have also built a considerable buffer, we'll then be able to buy the finishes to complete the project.
Fair enough. To move on to your Belgravia office park that has been in the pipeline, when do you expect to commence the construction of that 3-story building?
So that project, initially our plans was to start to works on site in Q3 of 2019. At that point, things really got bad in terms of your Forex. And we carried our viability assessment initially in June, and it showed that the project was viable. In very simple terms, the market value of the completed development is higher than the total development cost. We did the same assessment of viability around Q3 when we were about to start. It was very clear that building materials prices were going up. I think that's when we saw inflation really going up at a high speed. And we made a decision that maybe it's not the right time to start a project of that size, like you mentioned, 3 stories. And also when you look at the demand for Forex on that project in terms of steel, reinforcement steel, and also the finishes, it's a bit on the high side. So what we are doing now on a quarterly basis, we already have a full project team. We reassess the project in terms of viability. What we have seen, what we were seeing before the COVID pandemic is, yes, cost of construction had gone up, but it was starting to stabilize. So we're hoping to sort of reassess by end of Q1, which we haven't done, but we know that cost is still slightly higher than market values. So I would say that project, we have done everything. We have all approvals. We were just ready to go for tender, but at this stage, informed by the quantity survey, it may not be the right time to start, but we'll keep monitoring the market. And once we believe that it is the good time to start the project, we will go on site. But I wouldn't have a very definite answer, especially now, because apart from the macroeconomic issues, we have a new factor to deal with, the COVID. And I think the overall impact of the COVID pandemic is it's affecting production across the economy. It's affecting GDP. And GDP, when it goes down, it also pulls with it demand for space and also viability. So we will keep monitoring the macroeconomic environment, the property market, and when it is the right time to start the project in a way that will enhance shareholders' value, then we will start.
And I think at this point, it would be also important to find out what your current property yields look like.
Okay, so our year end was 30 September, and so I'm reporting the yield that we have is as at 30 September. So our yield came down to around 2% as at 30 September 2019. Mainly it's really because of the mismatch we have between the rental income and also the property values. So that led to the yield coming down to 2%.
Now that you just mentioned property values, what is the current situation then as far as the revaluation of your assets is concerned?
So ordinarily we carry out our valuations once a year at our financial year end, which is 30 September. We sat down and we had input as well from our board in terms of mid-year, and our mid-year is 31 March 2020 in this year, to say, do we have external valuations or we do an internal assessment and maintain our valuations for reporting purposes as of 30 September 2019. When you look at the property market now, there are a lot of distortions. To an extent, we don't believe that a fundamental assessment of value will give you a very good indication of market value in this environment. What is worse, which has actually added to the current distortion in the market, is the statutory instrument that then allowed those who are buying to pay for local products using foreign currency. And of course, those who are selling should not insist on foreign currency. It's more of those who are buying who can exercise that option. So what we have seen in the market is it has sort of led to some sort of misunderstanding, confusion, and we think we want to allow all that to play out before we do our fundamental valuations using an external valuer. So to answer your question, at the moment, what we have done, what our internal valuer is doing now, she's carrying out an internal valuations to assess the current scenario in terms of our last year and 30 September 2019, and now which information we also ventilate when we publish our results to say this is what we are seeing in the market. But I would say the market is very distorted, and it doesn't really help it much to give a very good indication of value because all the sort of inputs they are going through a transition stage, I must say, and we felt that we need to allow all this to play out and do as per norm our external valuations at year end.
Crystal clear, that is. Now, Gibson, can you shed light in terms of whether you have any plans to diversify from the CBD? Because it seems your property portfolio is skewed toward the Harare Central Business District and places of such nature. Are there any plans to move beyond the confines of the CBD space?
So yes, Eben, I think from our strategy, one of our pillars in terms of our strategy is diversification. And exactly like you say, is to diversify our portfolio. What we have actually learned as well due to the COVID pandemic is, and this is a global scenario, those who have a diversified portfolio, they are, in terms of the total impact, is better as compared to a specialized portfolio. So yes, we have been looking at opportunities to diversify from as far back as 2018. And we have some very good leads in Zhishawane, Bulawayo, and Victoria Falls. And some of those leads were linked to the tourism and hospitality industry. I'm speaking here now about Victoria Falls. And we are aware that the sector has really been affected at a global level. And when you then read reports from tourism experts around the globe, they think the sector will be the last one to recover. And you look at 2003, the SARS outbreak as well, the tourism sector was the last one to recover as well. So as we diversify, we want to relook at what we had originally thought to say is the best sort of model of diversification in light of the developments, emerging developments that are coming out now out of this COVID pandemic. So yes, we have plans, and as I've already indicated, we have good leads. In some cases, we have offered to buy properties, and we have agreed with the sellers to say, let's hold on for this pandemic to play out, then we will transact at some point. So yes,
still on that, just to catch you in the tracks there, you did mention hospitality, the thrust that you have there. Recently, you signed a $15 million deal with Touchwood International for the construction of a hotel at a charter building. What is the progress where that is concerned? And I think you also mentioned at our last conversation, plans for a water park in Victoria Falls. Would you shed more light where that is concerned?
Thank you, Eben. So let me start with Charterhouse. So yes, so the Charterhouse, we signed an MOU, like you said, worth $15 million sometime last year with Touchwood International. I'm happy to say the first step that we had to do as MASH was to secure a change of use permit from the local planning authority, in this case, City of Harare. And it's a very rigorous process that you have to do in terms of convincing your neighbors, convincing the local authority that the site is suitable for what you want to do. And I'm happy that we managed to secure a change of use permit after 6 months in November 2019. At the same time, we're also working on the designs for the reconfigurations, especially the interior. So our team managed to visit China, managed to view the hotels that are run by Touchwood in Shanghai. Of course, they have other hotels in Beijing, but we're all limited to Shanghai. Our designers and the Touchwood designers managed to conclude also the final designs, which have also been sent to the city of Harare, and they are nearing approval. We had a few issues in terms of the bearing capacity of the building, but we have now managed to resolve those issues in terms of the requirements of Touchwood, what they need, and also the existing bearing capacity of the foundations, and what we can do to ensure that we increase that capacity. So that has been done. Our plan was to start works on site in April 2020, but obviously because of the pandemic, we just had to stop, and we are now delayed in terms of our original plan. We are happy to say Touchwood, we are in touch, and they are very much excited about this project. In terms of to say when do we commence site works, I will not have a date, because it's really about containing this pandemic, and also government giving a green light, not just our government here, but also the Chinese government in terms of this big investment. But yes, all the background work has been done, and we are just waiting for the final approval from City of Harare of the bearing capacity proposals that we have, but we have already consulted them. They are happy, and we feel after the lockdown, we should be able to get the final approval and start works on site.
Sounds enough preparation has been done for that. Gibson, it's unfortunate we've run out of time. Thank you for enlightening us on the progress taking place at Mash Holdings. It's always a pleasure getting to talk to you, Gibson. And thank you so much for joining us, and good luck with the ensuing financial season.
Thank you very much, Eben, for reaching out. It's a pleasure as well to talk to you.
Danke. You have yourself a great one. Now joining us on set is an in-house analyst, Respect Gwenzi. Respect, good evening and welcome to the Earnings Review.
Thank you, Eben. It's always my pleasure.
Beautiful.
Actually looking fantastic today.
Much appreciated.
Sure.
Now, to make some draw outs from that conversation there with Gibson, of interest, I think, would be the issue to do with valuations of the company's properties. We are coming from a Zim dollar era that was purely stacked at that, and now we've got a multi-currency regime. How will it play out when the company gets to revalue its properties when the reporting season comes through?
Thank you. So I think one of the implications of de-dollarizing is that it brings a disparity between the currency or the valuation that we used to use in prior years and the current year. So moving from a USD-based valuation to a local currency-based valuation means you have to factor the impact of exchange rate. So all property operators, their biggest asset class, it's actually properties within their portfolio. So they have to revalue these in line with these dynamics in the market, notably the exchange rate movement. So suppose you had a property portfolio worth 100 million, and then the exchange rate moves from 1:1 to say 1:5. It simply means, in a way, you have to move your property portfolio in ZW dollar terms, multiplied by a factor of about 5 or so, or maybe somewhere close to that. So in essence, when you then record this 500 million from 100 million, you get to do the maths and come out with the difference between these two numbers, and you can easily call it other income within your broader top line calculation. So I think in terms of impact on the financials, you find your top line where you're saying this is my rental income and this is other income, and within this other income is that income which you realize from revaluing your asset. So when you revalue your asset, theoretically you are creating value by simply changing the way you are calculating this property. But in essence, it's not really money. It's just a theoretical way of presenting the fair value of your properties. So what we are seeing in 2019 is a situation where all companies, especially those that are predominantly hold properties within their portfolio, realizing these fair value adjustments on properties. But in essence, it's not really real income. So you have to adjust for it on the net profit position.
Fair enough. Now let's talk about how the property portfolio of the firm is concerned. It's 46% where office space is concerned and 43% industrial. With the playing out COVID-19, how is this likely to affect the financial position of the firm in terms of cash flows and other things?
Thank you. So I think for Mash, fundamentally, over the years, their portfolio has always been skewed towards CBD offices. That's the largest part of the office space which they contain. That's the part which has got about 46%. But when you look at the implication, I think looking at how the economy has evolved over the past few years, we have seen a gradual movement of economic players from renting in CBD to office parks as well as suburban offices. So you find a player moving from Harare CBD, occupying a space in Belgravia and surrounding places. Why? It's been a way of preserving preserving value and actually creating value for shareholders by minimizing your cost of rental. So there has been that movement, and most of these CBD office spaces have got low occupancy levels, have been having that gradual decline in occupancy levels over the past at least 7 years in Zimbabwe. So this has had an impact on the property companies which are overweight in terms of a CBD exposure. So when you're looking at March, this has been one of the challenges that they have faced. And now the dynamics around the industrial space, if you look at how production has evolved over the past few years, we find that with the capitalization, industry capitalization of just less than 30%, you would obviously expect that less and less people are occupying spaces within the industrial space as well. So I think this is why the company has, over the very past few years, tried to diversify into other areas, residential, hotel, and so forth. So obviously, these dynamics have shaped the income that they've been able to get, and also the strategy to try to develop outside the CBD. They're now trying to put up a development which they want to put as their head office outside of the CBD. So that shows you a realization that the game can no longer be played within the CBD space, which is the majority of their office space, as well as even the industrial space as well. There are other opportunities in leisure and hotel and so forth. So that's what they are possibly moving into. With COVID, I wouldn't really know the impact, but with value chains being affected, I think even those who use industry space for warehousing, definitely their demand is possibly going to go down. And some might even review or ask for reviews in terms of rentals and even in terms of occupations as well. So I think it's still evolving, but the route or what we project in terms of the outlook is that broadly, most sectors, including the property sector, is obviously going to be affected by this pandemic.
Now, as Zimbabwe's macroeconomic situation continues to worsen, we are actually seeing that on the parallel market, the Zimbabwean dollar is now trading at north of 1:60. In terms of investment options, which would be a lucrative investment option between the stock exchange and investment in property, given issues to do with valuations there?
So it's not always easy to make that decision from an investor perspective. And also, it depends with how deep your pocket is. So for you to purchase a property, you obviously need to have a significant capital outlay. So obviously, an investor who invests on the stock exchange can actually utilize small sums of money, spin it in a few counters, and you might be able to hedge against inflation risk and so forth. But to actually grab a property in this market, you need to obviously do off-the-market transaction in US dollar terms. And for any property from residential, in terms of the high density, you need to be holding at least 25 to 50,000 US dollars. And that's money that's that normal working class people in Zimbabwe are not able to even raise. So I think it depends with where you're sitting. But broadly, what investors are trying to do is to look at these short-term investments, highly liquid, and obviously playing through the money market as well as the stock exchange. These are comparable investing options or options of asset class where they could possibly push their money at. So I think investing in property is actually a good thing because it guarantees you for that perpetual income in terms of your rental income. But then you obviously need to be well-heeled to be able to invest in real property. But to invest in the stock market, you actually need, obviously, like I said, small sums of money. But the stock market is really going up very sharply. For March, the counter has gone up by 750%, like you mentioned earlier. And the broader index is up 700%. So that really shows you that investing on the stock market, if you are an investor with low liquidity, low values of liquidity, you actually get a higher return in the very short run. But in perpetuity, you actually need to solidify, diversify your portfolio as well. So I think property would be a good long-term investment. But on the short run, you obviously need the stock market to hedge your investment.
Well, thank you, Respect. It's always a pleasure getting your perspectives. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our informative website, www.equityaccess.net. Ibn Mabunda from Harare. This is Equity Access. Ciao.